Good morning, everyone. Thank you for joining us today. Today's webinar is going to be about the age of asset allocation because I think 2025 has been that kind of year where any investor who's practiced some level of asset allocation in their portfolio has actually come out stronger than someone who's played favorites with their asset classes. So we are entering a phase where asset allocation can actually make a difference to your outcomes. We're also at a point where we need to understand why asset allocation works for a lot of investors and how you can translate this simple financial principle into a long-term strategy for wealth creation. So without further ado, I'm going to begin the webinar. We'll follow a pretty standard format where we have some content on that we would like to share with you, following which we also look at doing some live Q&A. So thank you for attending and thank you for joining our Learning Saturday initiative where we share knowledge on a weekly basis. So I'm going to begin with a simple question, which is why is asset allocation important in the first place? So when you have a single asset, that asset has certain characteristics. One of the most important characteristics of any asset is that it is cyclical in nature. The second feature that assets have is that they tend to be volatile as well, even within that cyclical window. So, what you gain by adding multiple assets is to try to have that cycle evened out because different assets bring different things to the table, and you have some engine which is always firing for you in your portfolio. When you have a single asset, the volatility of the portfolio is completely determined by that one asset that you own. But when you follow a multi-asset approach, what tends to happen is that volatility evens out because when something is going through a down phase, something else is going through an up phase. And this is actually a mathematical concept because you have assets and you have correlations between assets in terms of how they behave and how they move in terms of price correlation or even a negative correlation, you get a much better investment experience because what tends to happen is they behave in different ways in the same situation. And this leads to an outcome where your risk levels are reduced, your returns are not compromised too much, and you have a more comfortable investment journey, which allows you to continuously participate and scale up. So, what is the downside of single asset or multi asset investing, right? So, when you look at single asset investing, you have much higher drawdowns, and this can again lead you to questioning the choices that you've made in terms of what assets you own or what securities you own, right? And when we start questioning our choices during drawdown phases, we tend to destroy wealth because one, we may sell those assets at their lowest performance levels, and two, we don't scale up at the right time, right? So on both sides, you're getting hit by this decision making. So at the end of the day, the most important thing for an investor is not about what investment or asset they own. It's about how they experience this journey. Because the minute your experience improves, your ability to scale, your ability to move on to bigger milestones becomes immediate, and that unlocks your full potential. So now I'm actually going to illustrate those 3 points with some data that we have. This was published by Mire with respect to four asset classes or four strategies that they looked at. They looked at gold because that has been something that every investor has been talking about this year. They looked at equities and they looked at fixed income. So when you look at these three asset classes, what you notice is your multi-asset strategy is always in the middle. It's never going to come out on the top of the table, but at the same time, you're never going to have a steep drawdown, and you're very unlikely to experience a negative year in terms of returns, right? Unless you're equity heavy, you've not bought debt at the right time, you've not scaled up debt, that's when you can have a drawdown in terms of multi-asset investing. But even an asset class like gold can experience consecutive years of negative return. So if you look at the period between 2013 and 2016, you see that gold has actually lost 5%, 8%, and 7% in 2013, 14, and 15, right? So these asset classes that we consider to be fail safe, which can never yield negative returns, that's actually not true. You can actually see negative returns even in these kind of asset classes. It's not just equity that can deliver negative returns to you. So keeping this important learning in mind, the idea of diversification actually gives you a much better outcome. Your returns will be moderated. And if you look at how multi-asset has performed, say in certain years, like if you look at 2012, 2014, these returns are not modest by any measure, right? If you're making on average, say 12 to 15% through this strategy, you're actually doing really well. And you can also expect a more conservative return if the portfolio is oriented towards a more conservative approach. So maybe you could be anywhere between 9 to 11% also on a cyclical basis. So clearly diversification adds value to every investor. So how can we go about this diversification, right? The idea is to first of all understand asset allocation, to understand how different assets behave at different points in time. And you get the key takeaway here is when you mix assets together, you actually end up with an equity like return with a much lower level of volatility. So the idea of low risk investing has to give you lower returns, or low volatility investing has to give you lower returns, is something that asset allocation can clearly debunk. You can get equity like returns, you can have lower volatility. So this is a situation where you get the best of both worlds. So now again, I'm going to show you how these returns vary, right? So this is actually a range of returns. So how often do you see, for example, equity returns being negative? And that's about 3% of the time. How often do you see equity returns being in the 12 to 14% category? And this is about 13% of the time. So when you think about what to expect from equities as an asset class, right? You're most likely to compound in this range of 12 to 16%, because that is almost a quarter of the returns are concentrated within this bucket. Rarely, or depending on how your security selection plays out, you can earn a higher return. But the probability of, say, a 30% or a 35% return drops to less than 1% or less than 0.5% at that return range. At the same time, if you look at where gold returns are concentrated, right? 15% of the time, gold is not going to give you any returns. This is something that most investors are not mentally prepared for, right? So the returns from gold can be 0 to negative almost 20% of the time. But on average, the next big concentration for gold is when you look at the 12 to 16% bucket. So when you're in a cyclical bull market for gold, you can see a higher return concentration around 12 to 15%. So debt, of course, being a more conservative asset class, your returns are going to be concentrated between 4 to 8%. It's not going to cross that. And I think if you're trying to cross that within fixed income, you're actually expecting the wrong thing from an asset class. What fixed income brings to the table is not its return potential, but its ability to stabilize what equity and gold cannot offer, its ability to give you a cash flow and to be or maintain liquid, right? But the minute you combine these three asset classes, your return probabilities are actually much more favorable, right? So you see that each of these bring different things to the table, and each of these together, like when you the combination has a much more impactful outcome in terms of bringing your return range into a more predictable zone. So that 10 to 18% is the space where you can expect most of your returns in a multi-asset strategy. Depending on the cycle and the favorability of assets, you may compound closer to 10%. But 12% is a good number to keep in mind. So now let's talk about correlation, which was the mathematical concept that I brought you notice when we were talking about volatility in a portfolio. So when we look at correlation, what you're trying to understand is if I have two asset classes, do they move in the same way because of the same factors, right? And ideally, if they do respond the same, then you're going to see a higher correlation, which will be closer to 1. And if they move in opposite directions or they behave in completely different ways, then you're going to see a correlation closer to -1. If there is no particular relationship that you can define, a linear relationship between the movement of these two assets prices, then you end up with a correlation which is closer to 0. So here, what we see is that equities are have a very strong correlation, whether you're looking at domestic or foreign, because your correlation coefficient is closer to 0.4, 0.5. But equities and gold have a negative correlation, which makes them a great pair to have within a portfolio, right? So whether you're looking at foreign equities or domestic equities, you see that the correlation is negative 0.2 to 0.3%. When you move on to fixed income, again, there's a slightly negative or zero correlation between these assets. And if you add silver into this mix as well, you see that there's a very low correlation with domestic equities and even lower correlation with foreign equities, but a fairly high correlation with gold. So gold and silver tend to have the same bull market cycles, and you have a negative relationship with fixed income. So fixed income is a great diversifier for a broadly equity portfolio. It's also a great diversifier in a portfolio that has precious metals within it. All right. So what is asset allocation all about, right? I think in today's scenario, why are we saying that this is the age of asset allocation? I think first, you have a lot of global shifts that are happening. Second, there is concern about Indian markets. And lastly, there is what investors want, right? So these are broadly the 3 points that I think make a lot of sense in terms of why we're looking at the present time as the age of asset allocation. So from a global shift standpoint, you're seeing rate cuts happen across the globe. You're seeing very wild swings in terms of inflation. And if we look at currency moves as well, so you've had the dollar relative to itself lose value through 2025. You can measure this with an index known as the dollar index or the DXY, where the DXY has lost close to 9%. At the same time, you're also, specifically if you've been tracking INR valuations in the last month or so, the rupee has lost a lot of value in the last couple of weeks. Now, this is at the back of the fact that India had much lower inflation print coming in October. The RBI has reiterated over the last few months that there is policy room for us to cut rates. And at the same time, the Fed commentary turned out to be a lot more hawkish, with more committee members wanting to hold rates in the December meeting. So the interest rate differential between India and the US kind of widened, which would make the dollar more attractive relative to the rupee. At the same time, India has also not made too much headway on a trade deal, and this has weighed on our merchandise trade deficit. We've also had higher gold prices weighing on the trade deficit as well. So with all of this going on, you need to have a strategy that is not just focused on one asset or one economy, right? You need to have some diversification, because broadly, why the US also is in a difficult situation, because US market valuations are expensive. There is a lot of talk about a recession. There are very viral videos that are circulating around on social media showing you that US markets are headed for a crash and India is not going to be insulated from that. Now, that might be a very extreme view that is going around. But at the end of the day, what you want to do is you don't want to predict what will happen in the market. You just want to be able to prepare for what would happen and be ready for whatever opportunities come your way. And uh, a cash strategy as well as an asset allocation strategy really prepares you for any event that can occur in the future. Now, when it comes to India, there is obviously we've been in a rate cut cycle, so your yields have been trending lower. So the idea of being able to uh, generate a very decent return from a completely risk-free strategy has uh, been something that you have to challenge, right? You're not able to earn your 7-8% from a government bond or a fixed deposit anymore. So you can't rely on one asset to give you that kind of return. You do need another asset. You do need to expose yourself to different asset class without compromising on the quality or the safety of your investment portfolio. And lastly, I think when we're looking at asset allocation, uh, you are getting some level of growth that's coming in through the variation of returns from asset classes. You're also going to be protected from the downside. And if you have a more defensive portfolio, then even if there is an external event or a shock, you do have some level of security, right? Um, so this is why we are in the age of asset allocation. There are a lot of global trends which are unpredictable. In India, you need to be very selective with your equity allocation. And lastly, asset allocation works, right? And the math shows us that it works for every investor in every portfolio through every situation. So now I'm going to introduce you to the 90-10 rule, which is basically a study that was conducted by Brinson, Hood and Biebauer, where they wanted to explain why portfolio returns vary, right? And this essentially means why is one portfolio more volatile than another portfolio. And when you break it down, it's not because of the stock that you select, it's not because of when you invest, it's really because of what assets you choose. So, how volatile and how bumpy your investment journey is depends on your asset allocation strategy almost entirely, right? The stocks you pick, the time at which you start your investing, all of that accounts for 10% of what volatility you experience. 90% of your volatility comes from asset allocation. Now, the tricky part with asset allocation is to know when to invest in what asset class. And that's why value addition from a professional can really help you, or somebody who understands cyclical investing, right? So what's going on in terms of cycles, what's going on in terms of asset valuations? Because when you think about an asset like gold or silver, how do you really value it? There's no cash flow that's coming from it. There is so if you look at gold, it's a little bit more tough because you can't even project supply and demand, right? Meaning it's mostly used only for ornamental reasons. So this is why having some structure to your asset allocation makes a lot of difference in terms of what you can completely achieve. So again, these are some returns that we're going to show you, that how your 50% equity, 30% debt, and 20% gold performs, right? So you do see these variations in terms of how your performance is going to play out. And the idea is you want a more stable return, because whenever there is stability, there is more confidence in doing what you want. And most of us tend to look at past performance as an indicator of what can be achieved, because that gives us some level of proof. Now, when you go through an asset that has deeper cycles, it becomes harder to use past performance as an indicator, because what you're actually going to see is that returns are very lumpy. So you have one phase where you have performance, then you have another phase where you go through a drawdown or you experience negative returns, and then you come back into your growth phase. But if you have a more stable portfolio, you do see more consistent return. So then if you want to use past performance as an indicator, or if you want to look at a more reasonable projection in terms of what you can achieve, then I think this is a strategy where you're going to see more stability, right? But you do, when you see excess returns, right? So if you know a multi-asset product can give you anywhere between say 10 to 15% as a standard return, and you're seeing higher returns, then you kind of need to look at what the mean reversion trend is going to be in that phase. So let's try to understand assets in terms of their personalities and what kind of roles they play in the portfolio. So most of us want to invest in equities because we want that high growth, high return metric showing up in terms of our wealth creation journey, right? So it is definitely the growth driver within the portfolio. And what you know is that your returns are going to be lumpy, meaning it will be volatile. You can have years where you have no performance or negative performance, or you're not really beating, say, even a fixed deposit. And then you can have years where you outperform by a wide, wide margin, right? So in the long run, everything evens out. But in the short run, you do see downside risks, you do see flat returns. And as long as you're participating in the listed equity space, your liquidity within this asset class is fairly high. If you move on to fixed income, you're more stable all-weather friend, right? It's not going to do anything exotic for you. It's not going to do a lot in terms of wealth creation. But at the same time, it's very reliable. So you're not going to see too much volatility. You're going to have a very fixed or determined return range from what the asset has to offer. And your downside is pretty much protected. But depending on the asset or the vehicle that you use, sorry, depending on the vehicle that you use, you may or may not have liquidity. So if you're a direct bond investor, liquidity is hard to come by. If you are participating through, let's say, a mutual fund, then your liquidity is much higher. Within the bond universe also, there is a hierarchy in terms of what is liquid. So your government bonds will tend to be more liquid than your corporate bonds, and higher rated corporate bonds have higher liquidity than lower rated corporate bonds. So keeping all of this in mind is how you need to structure your liquidity needs. And lastly, when it comes to commodities like precious metals or gold and silver, you do see them as diversifiers, right? Because they do what both equity and debt cannot really do for your portfolio. You have periods where they can outperform, and you have periods where they're not going to add much in terms of performance. And they tend to be more volatile than debt, but not typically as volatile as equities, right? So there is some level of downside that you need to prepare for, especially if you enter mid, say, cycle. And your liquidity depends again on the vehicle that you use. So if you have physical gold or silver, that is much harder to liquidate as opposed to digital forms of owning silver like ETFs or mutual funds. All right. So how can you practice asset allocation? You can have a static strategy, you can have a dynamic strategy. So in a static strategy, you set your weights and you just either try to rebalance it over time at some fixed frequency. And this ensures that you keep booking profits out of one asset class and moving it to another asset class. But this essentially what happens is that you miss tactical opportunities, you miss the opportunities that cycles give you. Then you can have a more dynamic approach where you don't have a fixed amount or a percentage that needs to go into each asset class, but you decide that amount based on where you are within the cycle. So you're basically looking at adapting the portfolio to what's happening in the market or what will happen in the market, right? So this requires more adjustments, it requires a more active approach and a thoughtful approach to maintaining the portfolio. And the outcome can be that you have better risk adjusted returns. So now I'm going to walk you through one of our favorite charts, which is something that LiveMint publishes every year. It's called the Asset Allocation Quilt. And basically what the quilt tells us is that every asset performs in phases. You don't really see something always being a winner. Winners can become losers at any point, losers can become winners at any point. So, again, if we go back to that phase between 2013 and 2015, you see that gold was a loser, right? And then, like, if you move few years down the line, if you look at 2018 till now, gold has been one of the top performing asset classes in this phase. At the same time, you can also track how small cap has performed. And you can see in years where small cap does not do well, it can lose anywhere between 20 to 35%. And that is something that investors are not aware of, because you only see these things making higher returns, right? So you see an upside of 35%, 50%, 60% in a given year. And that is what motivates a lot of people to participate. But these drawdowns can be fairly steep, and that is something that we need to be more cognizant of. So the idea is that the market moves and assets move in cycles, markets also move in cycles. And if you can bring some of these cycles together, then you end up with a much more even trajectory. So keeping that in mind, I think your smart allocation is basically your first line of defense in a challenging market. So you want to be able to diversify within sectors. This ensures that you're not exposed to a specific risk that a sector has. So, for example, this year a lot of talk has been about how AI has been a disrupting factor in the IT industry. You've also had many sectors exposed to the US deal with a lot of uncertainty because of how the tariff negotiations are going on. So if you're looking at textiles also, you would have gone through a lot of ups and downs within how expectations are being set there. So having sectoral diversification ensures that you're not concentrated within a particular segment alone. Whereas if you had exposure to, say, banking, which is more or less a more domestic favored theme, you're not going to be affected by the tariff situation, right? So this is broadly how you want to think about sectoral allocation, because some sectors can be affected very heavily by a few factors. You want to look at geographical diversification as well. So if you've been somebody who's thought that Indian markets are expensive, which is what FIs have been thinking for the last year or so, or if you're somebody who thinks the US markets are expensive, then the idea is to have global diversification so that you get exposure to different markets. You're able to keep that equity allocation at the level that it should be and expose yourself to those high growth assets. Lastly, when you come into asset allocation, you want to combine different asset classes. It can be a combination of equity, fixed income, precious metals, and global assets. This ensures that you're looking at a more balanced approach to wealth creation. And we've talked about what role each of these assets play and how low correlation assets coming together can actually give you a much better investment experience. So again, coming back, correlation is basically why diversification works. And you want to make sure that you've got the right asset mix at the right levels to get that great outcome. So our top 3 lessons from the quilt that I showed you. There are no years where all asset classes fail, right? Which essentially means there's no year where every asset class is going to give you a negative return. So it's worth owning a little bit of everything. The second is that you're going to win most of the time. So half of the time, pretty much all your assets are delivering positive returns, which essentially means that there aren't long periods of time where you're tending to lose in an asset allocation strategy. Whereas if you own a single asset, there can be a period of 2 or 3 years where you earn negative returns from a particular asset. The last is that we should learn to cultivate resilience within our portfolios, because at any point losers can become winners, winners can become losers, and the cyclical nature of markets is what will dictate how wealth is created or where wealth is created. So now I want to walk you through our drawdown metrics. We do run a multi-asset strategy called Sphere. This is a portfolio management service. And while it's great to talk about returns, I also think it makes sense to look at how risk plays out. And when we look at how risk plays out, this last year has been a great time for us to really understand drawdowns and see how products respond to these situations, right? So there are two time frames that I'm looking at. The first is from the Nifty all-time high to the Nifty all-time low. And if we see what the drawdown was, the Nifty had a drawdown of close to 16% in this time frame, whereas our multi-asset PMS drawdown was close to 10%. If we compare that against the benchmark that we use, there the drawdown was close to 8.5%, and the Nifty 500, of course, was even steeper than the Nifty 50, coming in at close to 18.5%. Now, if we look at the drawdown from Sphere's all-time high till Sphere's low, the drawdown was slightly more compared to the Nifty drawdown period, right? So that was about 10.5%. Nifty drawdown in this period was 12%, and the multi-asset index was much lower, coming in close to 6%. So, why do we look at these three benchmarks, right? The idea is that Sphere on its own has a higher equity allocation. That's why you want to benchmark against pure equity indices as well. Whereas the benchmark index, which is the multi-asset index, tends to have a lower equity allocation and a higher exposure to arbitrage funds. And this essentially means that it's directionally protected. About 40% of the portfolio is directionally protected from the way equity markets move. So now I've shared the performance data. Again, here if you look, our one-year returns have been close to 18%, our three-year returns have been close to 28%, and these are compounded numbers, and all these numbers are post-fees. Of course, given the higher range of since inception and 3 and 2-year returns, I think it's important for us to understand that cyclically, whenever you have a multi-asset strategy that does more, we need to anchor back to what is a reasonable return expectation. And I think we've narrowed that down to the range of 10 to 15% is what any multi-asset strategy can achieve for you without taking too much risk and giving you a great investment experience. This is also a good return metric to compound it. And across all timelines, we've managed to beat the index return as well. So what does Sphere do for every investor? I think when we ideated the product, we were trying to solve certain things that investors experience, right? And some of the things that we noticed is that people always wonder about whether it's a good time to invest now. So this whole week, it's all been about, oh, the market is getting to a new high. Should I just wait for a correction before I start investing again? Otherwise, when you see markets going through a downturn, like we did last year, a lot of investors were questioning why they should participate in markets at all at that point. Like, why don't I wait for some clarity before I start investing again? So once you decide that, okay, it doesn't matter, any time is a good time to participate, the question comes to when to scale up investments, right? So do I add more to my portfolio now? Should I wait it out and then add into my portfolio? And once you cross those questions, it becomes about, okay, where do I invest and how much do I need to invest? So these are all questions that every investor goes through. And Sphere is the kind of product that ensures that you never have to worry about these questions. It's always a good time to participate. It's always there's always going to be an opportunity for you to capture. And what matters is how much you want to achieve, right? So then the shift moves from what you need to do to what you actually want to achieve. And that I think is great in terms of getting you to say $1 million in wealth or your first crore or wherever you've set that milestone. It's a great mechanism to help you achieve that. So what do? We basically have found a way to challenge your risk reward equation, which is essentially the idea that, okay, I have a low risk strategy that's going to give me a lower return. I have a high risk strategy that's going to give me a higher return. And now I have to pick between these two. Now, as a multi-asset investor in Sphere, you don't have to pick between these two because the framework itself ensures that you get better outcomes because we have a value framework which protects you from the downside. We have a contrarian framework which ensures that you participate in the right asset class at the right time. And the multi-asset investing approach basically makes your investment experience a lot more enjoyable. So we operate somewhere between a conservative and a moderate strategy, and you can expect returns to be 10 to 12%. We are a SEBI registered PMS, which means the minimum investment amount per SEBI regulations is close to 50 lakhs. And we don't have an exit load, and we run a flat fee model of 1.5% of the AUM. And I think ideally any investor who wants to participate in a product like Sphere should come in with a 5 to 7 year investment horizon because that's when you really get to experience cycles within a market, right? And you get that entire flavor of multi-asset investing. But of course, there is no exit load, so any investor is free to enter and leave at any point that they want. And we have a truly flexible mandate allowing us to participate in any asset class between 0 and 100%, but we've historically held a higher allocation to equities. So lastly, just a quick thing in terms of what are the key takeaways from today's meeting. First, wealth is not just about returns, it's about managing risk effectively. You also want to know that diversification is key to creating wealth. How you do it, whether you want to do it within one product, you want to do it across multiple products, is up to you as an investor. And lastly, the next decade belongs to people who are going to be consistent allocators and not somebody who's going to trade because your cycles tend to run for years together. You want to capture the best of a cycle and not be shifting between asset classes, chasing performance. Idea when you're looking at how to align it with your goals, how to manage risk more effectively, and how to adapt to market conditions. So rebalancing blindly may not give you any of these outcomes. So keeping your rebalancing outcome aligned is another key takeaway. Please do feel free to reach out to us on WhatsApp. And you can always leave us a review on Google if you enjoyed this webinar or if you're an investor and you've experienced a good journey with us. So thank you so much for your time and patience and have a lovely weekend.